Before you put 20% down on your next home purchase, you need to watch this. I'm Matt Wilson, mortgage advisor with New American Funding, and today we're going to talk about whether or not it actually makes any sense to put down 20% on your next house. In a lot of cases, 20% down can save you money. Obviously, it gets rid of mortgage insurance and it's going to have a lower loan amount, which leaves you with a lower monthly payment. But that's only if we zoom in and only look at the mortgage. There's a few other things that you could use that money for that may make more sense over time. Let's take a look at the computer to compare some numbers side by side and see which one's going to be the right fit for you. So, say that you were wanting to move on from your previous home, you've outgrown it, but you've got about 120, $130,000 of equity there, and you're like, I can afford a much bigger house for my growing family. Sweet. You could take all that money and put it down in the next house at like 550 and have a 20% down payment and wind up with a monthly payment around $3,253, cash to close right there in line with what you've got out. That's cool. Saves you on mortgage insurance. Cool. But the thing that you have to keep in mind is your big picture. A lot of people will get stuck on what's the mortgage payment going to be, what's an interest rate on the mortgage going to be, whatever. I'm going to show you something that's going to blow the lid off of just worrying about one thing at a time. So, if you're like most families, you're probably going to have more than just a mortgage payment to contend with. You probably got a couple car loans, student loan, credit card, whatever. That being said, here's an example of what that would look like for most families. Now, if we added together all of the monthly payments here, then that totals out at 2,242 extra dollars every month. It doesn't matter how much the mortgage payment is, it matters how much your overall monthly payments are. Because if your overall monthly payments are going to be more, then it's less money that you've got left over to get to the end of the month with. All right. So, with that being said, let's see what it looks like with all of them added together. If you added all the payments together, then you're really at $5,496 a month in monthly negative cash flow. So that right there is your starting line before you've paid for any food or whatever. Moving right along, what if you took, instead of putting all that money down on here, you consolidated most of the debt? It's a thought. So let's see what that's going to look like. If you consolidated all the debt except for the student loan, just because if you're a math wizard, you probably notice there's not quite enough there to pay off the student loan too. It would actually put you in a position where your total monthly payments are now $4,196 That includes the $200 for the student loan payment. So, with that being the case, also your cash to close is going to go down a little bit just because math. You could technically, we can make that work a little differently, but whatever. Um, all right. So basically, what we've done here is we've knocked out this auto loan, and this credit card, and we freed up a bunch of cash. The thing is like the mortgage stretched over 30 years. The difference in $10,000 is like 50 or $60 a month. So that's why it changes there. But you're probably looking at this like, yeah, cool, Matt, except for now I've got a much higher mortgage balance, and that's not going to be very conducive to paying mortgage interest over time. You are correct with saying that. So what you're going to want to look at doing is make extra payments on it. So check this out. Yeah, if you didn't make any extra payments simply because it's a much higher mortgage balance here, the mortgage interest in isolation is going to be like $723,000. That is a boatload of interest. Sure. However, if you were to take and pay the difference there, the same cash flow you were already okay with to start with, that $5,496, see right there? If you were to take and pay that difference there, the extra 1,320 a month, you would actually lower your payoff time by 15 years to less than 15 years actually. And on the interest side of things, doing this would save you about $270,000. So if you were to put down the 20% over here, and we're not even counting the savings that you get and not having the interest on that other debt in this either. But you would have $587,000 of interest over the 30-year loan versus $308,000 over what would be a 15-year loan, and then you're completely debt free. So the big thing that I always like to tell people is you don't want to shoot your debt with a shotgun where you've got little BBs going everywhere. You want to shoot it with a cannon, put it all in one spot, cannonball that thing. As you can see, sometimes it doesn't make any sense to put all your money down on the next house. And in a lot of cases, you can actually get a whole lot more financial benefit for your big picture if you were to zoom out and use the money a little more resourcefully. My goal is to make sure that you know exactly what is going to get you the most benefit as you go into your next house. And if you've got any questions about what that looks like for you, go to the description. There's a link to my calendar so you can schedule a call and I'll talk to you personally. And if you are in the process of purchasing your first home, next home, or forever home, then there's also a free download link from my book, How to Make Getting a Mortgage Not Suck. That way, when you buy that next house, the process doesn't suck.